welcome to the deep dive. Today, we're really honing in on something we know many of you are thinking about: building passive income. You're looking for, well, a clear path to understanding how to get your money working for you.
That's right. And we're steering clear of the really speculative stuff today. The focus is on practical ways to build dependable long-term income. So our mission here is to dig into two specific companies, ones with solid histories of paying out consistently high dividends.
A potential shortcut, maybe, to grasping how reliable passive income actually works.
Exactly. Think of it that way.
And we should stress, these aren't flavor of the month stocks. We're looking at established businesses built for the long haul, not quick flips. We want to understand why their dividends are so robust.
Precisely. We've looked at the sources, and yeah, we're focusing on two names known for what you might call a significant yield. They are Enterprise Products Partners, ticker EPD,
Okay.
and Realty Income Corporation, that's ticker O.
All right, let's unpack that first one. Enterprise Products Partners, EPD, sometimes called the pipeline prince, I think.
Yeah, you could say that. They currently offer a yield around 7.3%.
Yeah.
And here's the kicker. They've increased their payout, their distribution, for over 25 years straight.
Wow, 25 years. That's consistency.
It really is. And what's compelling is their actual business model. Think of them as running the highways for energy.
Okay.
They own and operate this huge network: pipelines, storage, processing plants for oil, natural gas, petrochemicals. But the key thing is they mostly charge fees based on volume, how much stuff moves through their system.
So it's less about the price of oil or gas fluctuating wildly.
Exactly. That model gives them a lot of stability. Whether commodity prices are up or down, those fees for transport and storage tend to stay pretty consistent. It insulates them quite a bit.
So it really is like that toll booth analogy. You pay to use the road, regardless of the car's value. And the sources mention some pretty impressive cash flow numbers, too.
Oh, absolutely. In 2024, they generated over $7 billion in what's called distributable cash flow.
Distributable cash flow. So that's basically the cash available to pay out to investors, right?
Pretty much, yeah. It's the cash left over after running the business that can be distributed. And what's really prudent about EPD is how they manage it. They're only paying out about 55% to 60% of that cash flow as dividends.
Okay, so they're not stretching thin to make those payments.
Not at all. That leaves a really healthy cushion. It's crucial for making sure those payments are reliable long term. You see some companies with high yields paying out almost everything, which is, well, riskier. A lower payout ratio like EPD's usually means a safer dividend.
That makes a lot of sense. It's not just the yield today, but the ability to keep paying it, maybe even grow it. And they have grown it, haven't they?
Oh, yeah. For over 2 decades now. And importantly, they kept increasing it right through things like the 2008 financial crisis, the pandemic, periods of really volatile energy prices.
That kind of track record through thick and thin really says something about the business itself.
It really does. It speaks to resilience.
Now, here's something interesting the source material highlighted. The Duncan family's ownership stake in EPD. How does that play into things?
That's a significant point. When you have substantial family ownership like the Duncans have in EPD, it often leads to a more, let's say, long-term conservative approach to management.
Right. Their interests are aligned with the company's health over decades, not just quarters.
Exactly. They're likely prioritizing steady, sustainable growth and reliable income for everyone rather than chasing risky short-term gains. It contributes to that, sleep well at night factor people look for.
Reinforces that long-term stability idea.
Yeah.
Now, EPD is structured as an MLP, a master limited partnership. What are the tax implications folks need to know about there?
Right. This is important for you as a potential investor. Being an MLP means a chunk of EPD's distribution, the dividend payment, is often tax deferred.
Tax deferred, so you don't pay tax on it right away.
Often, yes, for a portion of it, which can be a nice benefit if you hold it in a regular taxable brokerage account long term. However, and this is the key thing, MLPs issue a Schedule K-1 tax form.
Not the usual 1099.
Correct. And a K-1 can definitely make your tax filing more complex. Because of that complexity, the general advice is usually to hold MLPs like EPD in taxable accounts, not in tax-advantaged accounts like IRAs or 401k, where it can cause other headaches.
Okay, good to know. So for EPD, high, growing yield, essential infrastructure, long-term view from management. But you need to be aware of the K-1 tax situation. Let's switch gears to the second one. Realty Income, ticker O, the monthly dividend company. That name says it all, doesn't it?
It really does signal their focus, and that's the big draw for many people. monthly dividends.
12 checks a year.
Exactly. A very
Yeah.
steady, predictable income stream that can be super appealing if you're trying to match income to monthly bills, like in retirement. And their yield is attractive too, currently around 5.9%.
And they're known as a dividend aristocrat, but specifically in real estate. What does that mean exactly?
So dividend aristocrats are companies in the S&P 500 index
Okay.
that haven't just paid a dividend for 25 straight years, but have increased it every single one of those years. Realty Income blows past that they've got over 30 years of consecutive annual dividend increases.
30 years of raises. Through recessions, market crashes. Everything.
Everything. It really highlights the stability and reliability baked into their business model and their dividend policy.
And the kinds of businesses they rent their properties to, it's a list of household names, really.
Yeah.
How does that tenant list add to the stability?
Oh, it's absolutely crucial. They own something like over 13,000 properties and lease them to big established companies. We're talking Walgreens, Dollar General, FedEx, 7-Eleven, LA Fitness, Sam's Club.
Yeah, places you see everywhere. Not small mom and pop shops that might struggle in a downturn.
Precisely. These are generally companies with strong financials, national footprints, providing essential goods or services. They tend to be much more resilient during economic slowdowns.
Makes sense. And the leases themselves are structured in a specific way too, right? These triple net leases.
Yes, exactly. Under a triple net lease, the tenant isn't just paying rent, they're also responsible for paying property taxes, insurance, and maintenance costs for that building.
Ah, so Realty Income just collects the rent, basically, without those extra headaches and costs?
Largely, yes. It significantly cuts down Realty Income's own operating expenses and makes their profit margins much more predictable and stable.
So similar to EPD focusing on infrastructure, Realty Income has a very deliberate strategy with their properties and leases. And the sources also mentioned their conservative management style.
That's another key piece. They maintain an investment-grade credit rating shows financial strength. They manage their debt smartly, staggering maturity dates so they don't have huge chunks due all at once. And those long-term leases we talked about provide a buffer against short-term market swings.
And, almost like a bonus, they tend to raise their dividend multiple times a year, not just once.
That's right. The individual increases might be small, fractions of a cent sometimes, but they do it frequently, often quarterly.
So it adds up.
It adds up, and it helps your income keep better pace with inflation over time. It's another sign of their consistent cash flow and commitment to shareholders.
Okay, so the picture for Realty Income is, like, owning pieces of essential Main Street businesses all over, getting monthly rent checks from reliable tenants, managed conservatively for long-term income growth. Now, a yield around 6%, 7%. That often makes investors nervous. Is it too good to be true? Is there hidden risk?
That's a really fair question. People are right to be cautious with high yields sometimes. But with EPD and Realty Income, the high yield isn't necessarily a sign of extra risk. It's more a reflection of their business models.
How so?
Well, these companies are essentially built to generate a lot of cash flow from their operations and then distribute a large portion of it. They're not really designed to hoard cash like, say, a tech growth company might.
So paying out a lot is kind of their purpose.
In a way, yes. They're not straining to pay these dividends. It's a natural result of how they run their businesses profitably. And as we've seen, they have strong cash flow, they keep payout ratios reasonable, and they have decades-long track records of paying and increasing those dividends. The focus is income generation, not just stock price going up.
Got it. So let's make this concrete. Could you walk through some hypothetical income scenarios? Say someone invests $100,000 in EPD at that 7.3% yield. What does the income look like?
Okay, $100,000 in EPD, that would generate roughly $7,300 in income per year.
Okay.
Which breaks down to about $608 each month on average.
And if they put that same $100,000 into Realty Income, ticker O, at its 5.9% yield?
Right. That $100,000 would just rate about $5,900 annually. And since it's Realty Income, that comes as roughly $492 every month.
Predictably each month.
Okay.
And what if someone split it, say $50,000 in each?
If you did 50 pay in each, your blended yield would be around 6.6%. So the total annual income would be about $6,600.
Which works out to
about $550 per month. That kind of income could definitely help cover some regular bills for a lot of people.
Absolutely. Now, taking it a step further, let's talk about reinvesting those dividends, the power of DRP, right?
Yes. Dividend reinvestment plans, or DRPs. This is where compounding really kicks in.
How does it work? Simply.
Well, instead of taking the dividend payment as cash, you set it up so that cash automatically buys more shares of the same stock.
So your share count grows over time.
Exactly. And then those new shares start earning their own dividends, and those dividends buy even more shares. It creates this like snowball effect. Your investment grows from the share price potentially going up and from owning more and more shares that are spitting out more income.
The source material had a pretty striking example with EPD, didn't it? Could you lay that out?
Sure. So imagine you start with $10,000 in EPD. Yield is 7.3%. You reinvest all the dividends. Now, let's just assume an average total return of, say, 8.5% a year that includes the dividend and assumes some modest price growth. But importantly, it doesn't even assume they keep raising the dividend.
Okay, a conservative growth picture.
Right. Over 20 years, that initial $10,000 reinvested steadily could potentially grow into a holding worth around $51,000.
Wow, from 10,000.
Yeah. And maybe even more relevant for passive income focus. At that point, based on the original 7.3% yield applied to your much larger number of shares, your annual passive income could be somewhere around $3,700 a year.
From an initial $10,000 investment, that really shows a long-term impact.
It absolutely highlights how powerful compounding can be when you just let it work over time.
Okay, so if these strategies can be so effective for generating income and long-term growth,
Yeah.
why isn't everyone doing this? Why the focus on, say, volatile tech stocks sometimes?
Yeah, it's interesting, isn't it? A lot of it comes down to, well, investor psychology.
The thrill of the chase.
Something like that. Many people are drawn to the excitement, the potential for quick, dramatic gains you might see in high-growth stocks. Dividend investing. It's powerful, it builds wealth steadily, generates income, but it can feel a bit, well, boring or less glamorous to some.
Steady Eddie versus the shooting star.
Kind of. Plus, you see common pitfalls. People chase ridiculously high yields that turn out to be unsustainable yield traps. Or they focus only on growth and never actually see any real income from their investments along the way.
So it seems like you, the listener, by taking the time to understand these income-focused approaches, are already setting yourself up maybe to make more grounded financial decisions.
I think so. By strategically looking at reliable income from fundamentally solid companies like EPD and Realty Income, you're building a financial base that's maybe less dependent on guessing the next big thing and more focused on consistent actual returns landing in your account.
Right. So wrapping this up, the main takeaway seems pretty clear. These significant dividends, these fat dividends from well-chosen, reliable companies like EPD and Realty Income, they're not just a nice yield number today.
No, they can be a really powerful tool for building long-term financial security, for actually creating that passive income stream people are looking for.
You've got EPD with its solid energy infrastructure, that potential tax deferral.
And Realty Income with the unique benefit of monthly payouts, those reliable tenants, and that incredible dividend growth history.
So maybe the final thought for you is this. While some folks are chasing the next trend or viral stock, focusing on consistent income generation from businesses like these, that might be the steadier path to building real, lasting financial muscle. Maybe getting a bit more peace of mind, too. Definitely something to consider for your own financial goals.